But let's talk about the auto industry for a hot second here, switching gears there. Shares of General Motors, we've been tracking those this morning in the pre-market, and now as we've opened up, they're higher by about 0.8% after closing Monday below the post-bankrupt $33 IPO price for the first time since October of 2020. So the broad market sell-off here also impacting shares of Ford, of Tesla, Chrysler parent, Stellantis as well. You're taking a look at this broader move higher in auto as right now we're seeing at least gains in Ford up by about 1% and really leading the autos at this point in time.
Yeah, so GM post-bankruptcy came back to the public markets on November 17th of 2010 at that $33 a share price. So it dipped below it in 2020, now dipped below it again yesterday. The shares coming into today were down 45% year to date, now rebounding a little smidge today. Ford is down 43% year to date. Tesla's down 39% year to date. This is all ex today's bounce. Stellantis down 31% year to date. So so many things are down a lot here to date, but obviously autos have really been struggling getting components, right? They are struggling even as their prices have been on the rise, their costs have been on the rise.
And here's the next shoe to drop. We've been so focused on tech companies like Coinbase being pushed by their investors and analysts to start cutting back on expenses. We've not heard those discussions happen in a lot of other companies. And you had GM CEO Mary Barra yesterday at their shareholder meeting just reaffirm the billions of dollars they're going to be investing in electric vehicles. I understand they have to, but I think the street, a nervous street, would have liked to hear a little more just being rational about how much they do intend to spend in an environment where as inflation and rates are going up. And that fits what you mentioned, the B of A survey earlier on. That was one takeaway inside of that report where fund managers would like to see companies start to pull back a little bit on their capex just to show that they understand what environment they're operating in.
Well, in the case of Ford, they've kind of positioned themselves for that, no? When earlier this year, they had really put out the strategy that kind of split the business in two, at least for right now, in the terms of the reporting, the financial reporting of it, and being able to say, this is our EV division, this is everything that we're going to be prioritizing as that next leg forward for Ford, and this is the ICE business, this is that internal combustion engine business, and if you're positioning a business in that capacity, it's perhaps in order to set up where you may need to make strategic reductions on one side of the business to support the continued investment on what you see as the new way forward for a company like Ford as well.
By the way, quick side note, just for fun, I just looked up the year-to-date performance of components of the S&P 500. Since I mentioned autos are down, so much is down. Not even a fifth of the S&P 500 is higher year-to-date. And you won't need two guesses to know what the top performers are, in what sector they are. Anybody?
Oil.
Energy, yes. Top 10 best performers are energy, Occidental being the best. It's more than doubled year to date. What a sharp contrast with what we're seeing from those automakers.